Okay, let's talk about the large IPO that opens today, Mankind Pharma. The company has already raised about 1,300 crores from anchor investors. And, there's a 10% OFS of 4 crore shares. The issue size is huge, over 4,110 crores. The total IPO is 4,300 crores. It opens for subscription today. Rajiv Juneja, the Vice Chairman and Managing Director at Mankind Pharma, joins in. Of course, the market cap of the company post the IPO will be to the tune of over 43,000 crores. So this is a large one. Rajiv, thanks a lot for stopping by and speaking to CNBC-TV18. I want to first start by asking you about the kind of growth that you see in the domestic market. I mean, compared to the industry growth of, say, 10% in the last 3 years, Mankind Pharma has outperformed with over a 12% growth. Is this outperformance something that you can sustain? Can you give us about a 2 to 3 year time horizon? What would the company be doing?
I mean, keeping certain regulatory things in mind, I cannot talk about the future, but look at the past of Mankind and make your own conclusion. 27 years back, we started with just nothing in our hand, just 50 lakh rupees, and created this kind of a organization where prescription-wise, we are #1 company, revenue-wise, we are 4th largest company, we are one of the fastest and the youngest company in India, reached to this particular level. Talk about anything about Mankind, you'll find that it is a very unique kind of a company. We have a wonderful consumer division. The chronic side contributes in the sales of Mankind to the tune of 34% and growing at a pace of 1.4 times to pharma industry. Even in the acute side, our growth is 1.2 times more than the Indian pharma industry. So what I can talk about future, you can make your own conclusion about that.
Rajiv, sorry, you said 34% consumer. What is 34%? I missed that. Morning.
Chronic side. Chronic
side. Okay, got that. And it's growing faster than the overall pharma side. Got that. Now, could you tell us so you got the pharma business and you got a very strong consumer healthcare portfolio as well, which has been doing very well, and it's very visible with a lot of advertising, etc. And kind of does, as you say, does seem differentiated as compared to other products offered by other companies, etc. Could you tell us how much do you spend on advertising broadly on the consumer side? And talk to us a little bit about the growth potential here on the consumer healthcare business.
See, when we started the company in 95, and when you're nothing, and you want to basically make a mark in the pharma industry that you should be noticed, the first thought was what? Be contrarian. So first you'll find in Mankind is that instead of starting like any other pharma company from bigger cities, we started bottom approach. And once we reached to a level, like for example, 50 crore rupees in 2000, in 1995, we were 5 crore rupees company. Our thought was always one that whatever we are doing in a year, can we do in 1 month? On this philosophy, we have always worked. In 2007, when we reached to this 500 crore rupees sales, then we thought of launching this consumer division. Why so? There's a reason for that. Because even in those days, because we were a small company, came from smaller town Meerut, people were still saying that it's a small company and they sell not affordable medicines, they sell cheap medicines. So they disrupted the market. So we wanted to give answer to the industry. So launched consumer division, because intangible benefit is when your advertisement is there on TV, your brand is also visible. Corporate branding is also visible. So keeping that in mind, and work very aggressively. And today, all the products of consumer division, Man-First Condom is #1, Braga News is #1, Unwanted is #1. And not only that, they command 30% share Man-First Condoms, 80% share in Braga News, 60% plus in Unwanted. So we have always been a kind of organization where thought is not for the sake of going and covering the market, always dominating and leadership.
Okay. All right. Hi, Rajiv. First of all, welcome to the stock markets. We're looking forward to this issue. And, you would have built this business very, very passionately over the last many years. But, before my colleagues take over, I just wanted to ask you one question. It appears all the senior appointments are from the family itself. Now, from a stock market perspective, you're like a professionally run company. Do you think at some point of time, you could open up to that thought? That's a bit of a concern. So I ask you, Rajiv.
So 3 months, we were just touring. We went to US, Singapore, Mumbai. From last 3 months, we're hardly there in office. So who is running the company? All the professionals. In last couple of years, this question was right 4 years back. In last couple of years, the job has been delegated. Every department, everything is run by professionals. Otherwise, a company with a 20,000 people cannot be controlled, cannot be run like this.
Sure. Mr. Janeja, I think Nigel was pointing to the fact that the CEO is from the family, the COO is also from the family. So if you look at other pharmaceutical companies which are listed and which you also want to compete with in tier 2 and metro towns, they all have professionals on board and are the top managements. So will that transition happen? Is that something that investors have brought up? Is that a concern that investors have brought up on the road shows? And is that a transition which might take place?
Nobody talked about this, but this thing is also playing in our head. One thing you'll find in mankind in medium term to long term, that family will be just sitting in the board. The rest of the things will be done by the professionals, because ultimate goal of organization is making this organization an institution. That with this, we are also working internally how to go forward in this particular line, and this will definitely.
Sure. Mr. Janeja, so that is a thought that maybe there could be some amount of transition of the top management to maybe, entities or people who are not connected directly with the family. Just a last question from my end is the Panacea Biotech acquisition. This is something which is brought up as a concern amongst a couple of analysts that maybe that 1,800 crores was too expensive for those 70 brands because only 2 seem to be outperforming within that space and sales have been stagnant. Margins are questionable. So the end point is that when is the payback of that 1,800 crores of the Panacea Biotech acquisition? And in hindsight, do you think that was possibly a correct move by the company?
See, whenever you look at any organization from a distance and you have only data in your hand, this kind of analysis is not wrong, actually. But just scratch the surface a bit, slice and dice, and you find that this is an amazing kind of an acquisition. I give you some reasons for that. Number one, we got their transplant business, which is very, very difficult to enter. We asked a question, can we create this kind of a business? The answer was no. There are approximately 2,000 doctors who do organ transplant operations in India. Out of 2,000, 400, 500 doctors do 60% of the work. They are very niche, very difficult to enter. So they have great portfolio in that side, number one. Number second, they have one product, Sitcom, which is their patent product. How many products are patented in India? You can ask yourself. Rare. Sure. We got that. It is it can multiply to a different level. Third, their Glycid, again, chronic side. Still number 2 brand in its category. And not to forget Nemolid, which is an iconic brand, not doing good. That would be shifted in our consumers. And on the top of it, gross margins of Panacea are more than Mankind. And once these products will be shifted, manufacturing will shift in our own factories, gross margins will further improve. I'm keeping everything in mind. This is a fantastic kind of a acquisition. This is basically one organization which is not properly, its products are not being properly utilized, exploited to the fullest. We feel we can do wonderful with this, and we are still wonderful. And this kind of companies if they
Mr. Janeja?
Yeah.
Got that. I understood that. So you're saying that the gross margins of will pick up, I'm sure, in the future as well. But I wanted to understand more about what the growth plans are in the consumer business as far as exports are concerned. Any thoughts to take any of your consumer brands to a market like the US? And what could be in the pipeline for the company over the next 1 to 2 years?
Why US only? Why export only? Why not India only? We're a domestic company. 97% sales of Mankind comes from India only. So 97% focus is India. And we see as far as the consumer products are concerned, it's not number of products which matters. It's basically, the same products, how big it can become. So look at Mankind or Unwanted or Braga News. There can be a question that Braga News commands 80% market share, but people do not know generic version of pregnancy card sells many times more than Braga News. So we are still supposed to crack that. It can multiply to a different level. It can still become very big. On the side of Manforce condoms, we are premiumizing Manforce.
Got it. Good to hear that passion. So it's wonderful. And Mankind has been a clear disruptor in what was a pretty sterile market. Kudos to that. Just a quick question, Mr. Juneja. You know, your stronghold when you started was rural, and I think that still is the stronghold in India, right? Domestic. Will that remain that way? Do you have some numbers? What's the split when we look at Mankind's sales, urban and rural, etc.?
See, that legacy still plays in people's head. Actually, 5-6 years back, it was all right. In last couple of years, 4 or 5 years, we have added 18 more divisions. We have opened a new office in Mumbai. We hired a top professional from a different company who was running the chronic side of the business. Look at any which way. We are doing fantastic in metro. We are doing very good in rural.
Okay, urban as well.
You see industry as a whole.
Yeah, okay, fair enough. Research spends for a pharma company at 2.5% of sales seems a little low. Would that go up over a period of time?
Could you repeat the question again, please?
The spend on research at about 2.5% of sales seems a little low on the lower side. Would that go up?
This will not grow up because our focus is towards India side, and you're comparing with other companies, those who have more exposure towards export side. That's one reason.
Okay.
This will remain the same.
All right. Mr. Juneja, before we let you go, just one quick clarification. Has, the related party transactions with, say, your subsidiaries and associates been brought up when you have met investors? You've seen a strong anchor allocation, but is that one of the concerns which has been brought up in the past 3 years?
But it has never been done. Otherwise, the names you have heard in our anchor list, names like Canada Pension Fund, GIC, and BlackRock. You name any foreign institute. You look at any Indian domestic mutual fund, whether it's SBI or HDFC or ICICI. Everybody has gone for it because they must have seen something. And we basically have a wonderful governance.
But has it been brought up as a concern? Have there been questions asked on that?
Not at all. Not at all. When the questions were asked, we replied. We gave the clarification as well. And don't forget that 2 investors are already sitting in the board of Mankind from last many years.
Okay.
Okay. All right. Rajiv, thanks so much for stopping by, filling us in with a good idea about the company. How do you see business as well moving ahead? But I'll tell you what, Rajiv, when you join us post-listing, we'll be looking forward to some numbers, some guidance on how you see the company shaping up. For the time being, appreciate you joining in and giving us all of those details. Well, time to move on then to our special segment, Quarter Se Quarter Tak. Surbhi today brings us expectations from the consumer durable space. Surbhi?
Q4 is generally a strong quarter for the consumer durable sector, usually due to higher dependence of summer-driven products. However, this time, the summer-led demand did not play out as expected. Now, this was largely due to unseasonal rains. To push demand, companies did start offering higher discounts, but the continuing inflation pressure did not aid the volume growth. For Q4 FY23, among all the players, IFB Industries is expected to outperform with a revenue growth of over 20%, while other players are expected to see a revenue growth of anywhere between 4 to 15%. High competitive pressure and lower volumes are likely to impact EBITDA margins. Blue Star and Voltas are expected to see an EBITDA margin expansion of 20 to 50 basis points, while Whirlpool is likely to see a decline of 20 basis points. Now moving on to the consumer electrical segment. The outperformance from the largest product category, cables and wires, is expected to continue, backed by high demand from the industrial segment. For fans, however, primary sales are expected to be lower due to high inventory of non-rated fans. The key outperformers in terms of revenue growth is likely to be Orient Electric. Now, this is largely because of a low base, and Polycab, which is led by growth in the cable segment. Crompton Greaves Consumer Electricals is expected to see a revenue growth of 18%, but this is largely due to their merger with Butterfly Gandhimathi. Higher commodity prices are likely to see an impact on their EBITDA margins. All companies except Bajaj Electricals are likely to see a contraction from anywhere between 20 to 300 basis points. Bajaj Electricals will, however, see an expansion due to a lower base. Crompton is an outlier here. The company will see the highest EBITDA margin contraction due to increase in expenses due to Butterfly integration. Some things that we'll be watching out from the consumer durable space is 1. Management commentary about the demand revival. 2. Any price review decisions, whether they revise the outlook on margins, considering the high competitive pressure. And 3. Their future growth or capex plans. Finally, leaving you with the valuations. In the consumer durable space, Voltas is trading at 46 times FY24 PE and IFB is inexpensive, trading at 22 times FY24 PE. In the consumer electrical space, Havells is the most expensive, trading at over 50 times FY24 PE, while the rest of the players are trading anywhere between 30 to 40 times FY24 PE.
All right, Surabhi, thanks a lot for that. Well, Harshit Kapadia, who's the Vice President, Industrials, Consumer Durables and Electricals at Elara Capital, is joining in. Harshit, good morning. I think the focus has now moved away from earnings and onto the organizational, restructuring that we've seen for Crompton, right? The stock is down almost 12%. I understand that there is a bit of uncertainty because Mr. Promeet Ghosh, who's taking over as the new MD and CEO, may not have the caliber to take the business forward. At least that's what the street believes. There's some uncertainty there. But your own thoughts as an investor, how do you approach it?
Rightly said, Mr. Shantanu Khosla and Matthew Jobs did an extremely wonderful job in, recreating and reshaping Crompton Consumer with new products and rejigging its distribution model, coming out with innovative products. So compared to that, we don't have Mr. Matthew Jobs right now on board, but Mr. Khosla would be as an executive vice chairman for a year and then will be taking a non-executive role. And Mr. Promeet Ghosh, who's largely been an investment banker in his most of his career, is right now given in charge of this new entity. So investors as well as analysts are worried about, how things are going to play out with the integration with Butterfly Gandhimathi. So we'll be more cautiously watching on his strategy and, how he wants to, redo this business and his strategy forward.
Hi, Harshit. Good morning. Harshit, how do you approach this space, though? These unseasonal rains, they were a bit of a dampener, but you think things are still back on track? And what's your top pick from the space?
So things are still uncertain in this market as well. It's largely on the consumer durable side. But April has seen some momentum picking up with summer also picking up. So that is partly a good news. That is what we hear on ground. However, on the pricing front, still the price concern remains. None of the companies are able to take a price hike, so margins are going to be soft. If you remember, last year April has been one of the best ever month in life of durable industry because we were coming out from 2 bad years of COVID in summers. So we are coming from a high base, so that will also have some sort of repercussions on the growth part as far as April is concerned, but we'll keep on watching this space, though there is a hope of extended summer, which can also make sure that the market may revive. So that is a hope that we are building on.
Harshit, just to go back to Crompton, what's it trading at now in terms of valuations if you've given it a look after today's correction? We've not heard from the management yet. Maybe there will be a call later this week. Maybe they'll join us to talk about the changes, the incoming CEO. And what would you like to hear? What will get confidence back, in your opinion? Valuations and what would you like to hear?
Sure. So on valuation, so on FY24 basis, it is trading somewhere around 28 times my earnings multiple. my earnings. As far as what would what investors is going to get a confidence back, so largely on the growth part. So there has been a key challenge, for Crompton Consumer. They have not been able to grow, gain market share, compared to what some of the other competitors are. The strategy on the new bean rated norms have not played out well. So how they want to now rejig this, this fan business in terms of the new norms which they have set up. And the appliances business, largely the butterfly Gandhi Mate business, how are they going to integrate and use some of the products, in the future? Is it possible to sell it under Crompton brand and, take over the market? So some commentary on that side would be awaited.
So, if you look at the entire consumer electrical space, you compare the valuations, right? Havel seems to be the most expensive. Our colleague Surbi was just telling us that 53 times FY24, while Polycab is the least expensive at about 31 times. So just from a valuation parameter, do you think the risk reward is favorable in names like Polycab?
Yes, certainly. So Polycab is trying to become from a B2B player to B2C player. Right now, the FMEG business has touched close to 1,000 crores. So from 1,000 to 2,000 crore is where the big movement may happen, but it will take some time. So as things improve in Polycab, I think the re-rating in Polycab will continue. And as far as Havells is concerned, possibly there could be some deterioration in valuation as the demand has seen some impact, and their margin recovery is the most slowest among the consumer electrical players.
What about Orient Electric, Harshit? That had a bit of a re-rating in the middle. At least that was a candidate. The street believed with Mr. Khanna in charge, things would look up, market share. He had a focus on growth. Now, post him moving away, what's your view on the stock?
So in Orient Electric also, see right now, they have also started enter a new business called for wires. So which is more of growth oriented, which is a margin dilutive business. My sense was they were focusing on margin recovery as a first step and then growth. But however, now that it seems that their call is now more on growth and less on margins, so which won't be viewed very discreetly as far as the stock is concerned. But once the demand revives, there could be a different scenario for Orient Electric. But they are the front runners in terms of new launches as far as fans in the BE rating norms are concerned. So they have done fairly well as far as peers are concerned comparative.
Okay, just coming back to that, discussion about valuations in the consumer electrical space. Havells as a stock, if you look at it, if you map the last 1 year, in fact, last 2 years, the stock has done nothing for investors. It's been absolutely flat, and then there are these expensive valuations, right? Would that be an avoid for you, or do you think that it still deserves a premium that it's trading at?
Havells will always trade at premium compared to their peer set, and for the right reasons. So, however, at 53 times or maybe 50 times, it is to a premium. So there could be some, correction which may take place as far as the business is concerned, because they have not been able to upscale their margins. So that has been a key, position that people are watching about as far as Havells is concerned. So any recovery in margin for them, a substantial recovery, may re-rate the stock. Till that time, it may not be a good buy at this point in time.
All right. Harshit, thank you very much. Good speaking with you. Appreciate you joining in with that quick take on the consumer businesses and what should we expect from the quarter. A take on Crompton and the sharp cut that we're seeing is still down about 11.5%. We'll take a break here. Markets absolutely flat, 3 or 4 point change. Will we see like yesterday a bit of a move a little later in the day, or is this going to be a sideways session? We'll find out. Mitesh Thakkar is going to join us with some sense on what trades to take now. That's the conversation coming up after a quick break.
Welcome back. Well, the markets are as flat as can be, but the Nifty bank, that's the one that's bucking the trend. Even yesterday, that was the one that was taking us higher. So it appears that initial dip that we saw got bought into, and now we're trading along the flat line. But what's encouraging is the broader market outperformance. You have 1,900 stocks that are advancing. That compares with around 850 stocks that are declining. So this crisscross line should come up for you. You'll want them to be as apart as possible, and that seems to be the trend, at least in the first hour. Mitesh Thakkar is back with us. Mitesh, what do you make of this morning session? On the Nifty, we're virtually unmoved, but do you think that the trend is still up?
Morning, Nigel, very much. And, while it's a subdued first hour, I think that still doesn't change anything. I would believe that as the day progresses, there's a stronger chance of us heading higher. And a test of 17,820, 825 is what I would look for. If not today, then by tomorrow, sometime afternoon. So staying long over here, I have two buy calls. Exide Industries is a buy with a stop at about 188 for targets of 205. Disclaimer, we have some futures long positions over there. So we have vested interest. And the other one is Bajaj Finance, which is also given a good breakout on the hourly and the 2-hourly chart. So that's a buy with a stop below 59.40 for targets of around 61.95.
Okay, Bajaj Finance is doing well. And the other stock that's hit a new high today, guess what, is ITC. No surprises here, but once again, ITC at a fresh 52-week high, 409 rupees on that one. Bajaj Auto is the other one. Ahead of its earnings today, it's hit a fresh high. And Glenmark Pharma is also at a fresh 52-week high. So looking pretty good there. Anupam Rasayan is the other one. We've been talking about that ad nauseum, 65% higher. And as we mentioned, they'll be supplying new age specialty chemicals, advanced intermediates for the next 5 years. They've signed a letter of intent worth almost 400 crores with an American multinational. And the stock, as we speak, is at a fresh 52-week high. But on the flip side, Crompton is under a lot of pressure. And if you're wondering why, Surbhi is here to tell us more about that. Surbhi.
Thanks so much for that. So Crompton is in focus today as the company has announced a realignment in its top management. Promeet Ghosh will be taking over as MD and CEO of the company as Matthew Job resigns from his post as CEO and Executive Director. Now, Promeet Ghosh was a deputy head at Temasek India for almost 10 years. He served as a non-executive director on board for Crompton for almost 6 years and Schneider Electric's board for almost 2 years. Now, the major concern for this incoming CEO is he lacks professional experience to run a electrical company. The second management change is Mr. Shantanu Ghoshla, who was the previously MD of the company, as appointed as the Executive Vice Chairman for 1 year with effect from May 1st, 2023. And thereafter, he will serve as a non-executive Vice Chairman till December of 2025. Now, just to alert, the CFO of the company has also resigned in May of 2022. So the major concern for this cheat is the lack of operational experience for the incoming CEO, and also if there will be any more changes in the mid-level management going forward.
Surbhi, thanks very much for that. Zomato, though, is higher. Mangalam is here to tell us why. Mangalam.
Well, we're back to, the pre-COVID growth searching areas for both Zomato as well as Swiggy. And that's exactly what a City note says, that both Swiggy and Zomato have introduced monetization in the dining out space. If you've seen the recent ad of Zomato as well, you'll see that, users can go ahead and book tables in restaurants via the dining tab on the app or the dine out tab for the Swiggy app itself. Now, the rollout currently is limited, but what it does is it provides a potential monetization opportunity for these players. The biggest opportunity here is that, say, for instance, it rolls out and there is a steady stream of people booking their tables via these apps. The companies can go ahead and then, incorporate take rates for the restaurants, etc. While there is not enough clarity yet, this is a step in the right direction, and that's what Citi says. They will await more clarity on commercials before incorporating this into their model. What does their model comprise of right now? 70 rupees is the price that they give to Zomato, 6 rupees is the price that they give to Blinkit, and with that they arrive at a target price of 76. They have a buy rating, and that's one of the reasons why the stock is up. The other one, of course, was there was a fair amount of volumes being traded on the exchanges. There was a small, large trade as well.
Mangalam, thanks very much. Stocks at about 58, target of 76. In a way, life coming full circle for Zomato, because they started life as a app to find restaurants, and then they, of course, entered delivery much later. The delivery business is, of course, seems like the only thing they do because it's so dominant. But they started, of course, as an app to find restaurants, book tables, etc. and they're getting back into it and charging for it as well. 59 on Zomato, stocks up. We'll take a break here. We are back. Arun Selvan, President and Chief Financial Officer at Cholamandalam Investment and Finance, joins in to discuss their fourth quarter numbers. They reported the business update as well for the fourth quarter. Stay tuned. That conversation comes up next. Okay, there is some evidence of green on the index as well. Just 5 points right now. It's not a big recovery or anything. It's been very tightly ranged market. But 17,750 or so is where we are at. Now, Cholamandalam Investment and Finance is in focus. The company saw strong rise in new loans. Fourth quarter disbursals are up 19% month on month, and collection efficiency stands at about 130% for the quarter which has gone by. Arun Selvan is Vice President and Chief Financial Officer at Cholamandalam Investment and Finance. Mr. Selvan, good to have you with us here as always on CNBC-TV18. Thank you very much for your time. You know, I remember last time we spoke, you had indicated, we were talking about lending rates and what the RBI can do, cannot do. Since then, we now know that the RBI has paused and they want to take a view in terms of what happens next, want to watch inflation and then decide. They made it clear it's a one-meeting pause, does not mean that it's going to be a long, extended one. Could you tell us from your business standpoint, what has this really meant? Have you seen any changes? Have you been able to, have you effected any change in your lending rates to consumers because of this? What difference, if any, has this made?
Actually, sorry, I came on this call to discuss about the public debt rise. That's the only thing. I'm not talking results because we are not at risk come out with our results. With regard to the lending rate, I'm seeing, MCLR increases are not happening across banks. So there is a pause, not only by AWay, but also by most of the banks by not getting into further increases. So we expect, a positive thing, but it is a little premature to take a view on either way, whether there is a pause or will there be further increase in the rates. So we need to wait and watch. It may also depend on what the Feds do in the subsequent meet.
Mr. Selvan, good morning. Can you tell us a little bit about the fundraising? What is the purpose of raising funds? And, what is the plan going forward? Any more options that you're looking at to get money on the table?
Yes, that is the purpose. The purpose is that so far we have been dependent on banks and the private placement of entities. So right now we are looking at other opportunities to tap in other investor profiles. So this is an experiment towards that, where we are looking at raising retail entities. So we got a IM created for 5,000 crores, but right now the first issue is for 500 crores base plus a 500 green shoe. So we are looking to test the market and see how the response is, and if there is a good amount of positive response, then we will further scale this up as we go over this year. This is to build an investor franchise for our liability side over the next few years.
All right. Hi, Mr. Selvan. Good morning. Could you run us through what is your mix as of now? Your borrowing mix, as you said earlier, it was banks and private NCDs. So what is the mix? Where do you see this headed? And how much has your cost of funds gone up?
So the mix right now is bank term loans in the range of around 50 to 55%, the NCDs in the range of around 17 to 20%, and then you have securitization to the extent of around 10 to 12%, and then you have the rest are CPs and Tier 2, etc. But most of these are direct placements or direct negotiations with banks and the mutual funds or other investors in the organized space. So we right now wanted to also look at going to the retail space. Chola has always been earlier a deposit accepting company, but subsequent to the TBS venture, the deposit accepting license had been surrendered, and post that RBI has not been issuing fresh deposit accepting licenses. So right now we want to tap the retail deposits, retail NCDs. So in that context, we have come up with this particular issue. We will see the response. We have good franchise across the nation, so we are confident that this should be a successful venture. And if this proves to be good and cost effective, we will scale this up in the quarters and the years to come.
Can you give us a sense of what's happening in the commercial vehicle sector since you lend to this space? The disbursals in Q4 were very strong, but in general, is this a start of some sort of a multi-year upcycle in the CV space? And to the guys that you lend to, is it more for new commercial vehicles, or is it the replacement demand that's picking up, the used commercial vehicle space that continues to grow? Any sense that you can give us?
Yeah, we had been at a very low on the auto sector, so this has now come around, and going by the investment cycles that we are seeing, there should be a good amount of growth both in the new as well as in the used. The segment which we cater to right now is more focused on the used, because we don't fund many of the fleet operators. So the news generally happen at the fleets, and the fleet operators are now selling off their existing vehicles. So that's created a market in the used segment, and we are tapping into that also. So you will see both new and used picking up in the coming quarters.
All right, Mr. Selvan, in the past, I know you're in the silent period, but you have guided that mid-20s growth is something that you can do. 20 to 25% odd. You're holding on to that, and I think new business as a percentage of AUM, I think that was in mid-single digits. And you were looking at scaling that up. So we don't want a near-term target. Say in the coming years, what is the target out there on growth and new business?
On the new businesses, they will become, they will be around 15 to 20% of the overall AUM of the company in the next few years. That is also subject to our, our experience of being successful in these new products. We have brought in 3 new products, so all the new products are so far doing very good. So if that trend continues, and they should be, in the range of around 15 to 20% in the maybe in the next 2 years.
Okay, and overall AUM growth 20 to 25% by current reckoning, is that doable?
I would rather put it, because still we are largely dependent on the vehicle finance. I would say that we should be at least 5 to 10% above the growth of the auto sector. So that is what we would try to keep it. So wherever the auto sector growth happens, we should be slightly above that growth level. We should clock that level of growth instead of trying to fix a number to it.
Okay. Another thing I wanted to just check with you before we wrap up. You said that there's good growth that you're seeing in new and used commercial vehicles. Any other spaces? I mean, you cater to a whole host of sectors. Any other spaces where you see, a big revival? And what kind of growth are we looking at within those spaces?
We are growing, decently well in the LAP and the home loan segments also. These are segments where we have been experimenting over the past few years, and we are now, quite confident of growing these segments, and so we should grow these segments in the days to come. And you have already seen their growth numbers are much ahead, as compared to vehicle finance, because the base is low and there is a potential. So this should give us the good growth legs to around these products. The new businesses, we will experience it and then scale them up. Right now, we are still in the experimental or experiencing, space right now, and so we will see how they pan out, and then if there is good amount of growth, we should do it. These businesses are ROA accretive, so if they have good potential, we should really be able to bring them, to a larger proportion of the AUM.
All right, Mr. Selvan, final question before we let you go. There was some buzz about some inorganic growth. I just want you to clear the air, Mr. Selvan. Is there any possibility out there? Various rumors were doing the rounds. Anything out there, or you want to deny it totally?
Unfortunately, the rumor was created by you, and we have denied it, and you failed to add that denial also right now. So I will take this opportunity to say that there is no such case, and we have never pursued inorganic growth in the lending side of the book.
Okay, we'll take your clarification on board. Mr. Selvan, just wanted you to clear the air, but yes, we take the denial on board. Thanks so much for joining in. We couldn't talk about any numbers, but post your Q4 numbers. We look forward to having a longer chat and getting some outlook as well from there on. Pleasure speaking to you, as always. Well, time to move on then to the commodity space. Manisha Gupta joins us to run us through that one commodity that she's tracking this morning. Morning, Manisha.
Morning, Nigel. I'm looking at the rubber prices because we have seen constant gains come in for this one. And in the overnight markets, the price has gained up by 2.5%. Remember, the last year wasn't so great and we closed 2022 with nearly 28% of a decline. And from its highs, the rubber prices still are trading at around 30% on the lower side. But we do seem to be looking at prices picking up on the lower side here. So we're trading at a 6-week highs in the global markets there. And for the Indian markets as well, the RSS4 rubber, which is the one that is tracked the most, is trading at 186 rupees per kg right now. Good demand coming in for the Indian markets. The crop seems good. The import numbers are on the higher side as well. But the major trigger clearly for the global markets has been the Chinese rubber demand, which seems to be surging right now. So much so that the ground premium also has been building up in last couple of months right now. The Chinese data has been positive, not just the first quarter GDP numbers, but the auto production numbers have gained up in the month of March by nearly 15% on a year-on-year basis, with the street anticipating that with the kind of car sales numbers that they have been registering on a month-on-month basis, you could be looking at more demand coming in for the tire sector. This is a report that has come in from the International Rubber Consortium, which says that with the way the things are going on and the Chinese demand coming back, you could be preparing for a supply tightness in the first half of 2023, which could spill over in the next year as well. And then there are concerns about production as well from the major producing countries like Malaysia, Thailand and Indonesia. The Malaysia numbers have been out as well, and the production is nearly 2.7% lower on a year-on-year basis. We have seen adverse weather, drought in many of these countries, and there have been leaf diseases as well, which has brought the yield on the lower side as well. Overnight, there also was report that Yunnan rubber output has suffered due to weather. The numbers are yet to come in, but that is another thing that the prices have taken cognizance of. So 2.5% up on the overnight markets and nearly 5% up on the previous week is how the rubber prices have been trading.
Okay, thanks a lot for that. Well, let's also focus on some important numbers. It's a big day of earnings. You have auto major Bajaj Auto that will be coming out with its fourth quarter numbers today. The stock is at a fresh 52-week high. It's up almost 20% this year already. But the numbers are expected to be a mixed bag. The revenue growth will be in low single digits. That's because although the domestic growth has been very strong, exports have been under pressure. So the domestic two-wheeler segment grew over 15%, while the export volumes are actually down almost about 38% year on year. And export demand continues to be impacted because of issues happening in markets like Nigeria, which is one of the biggest markets for Bajaj Auto. There's the devaluation of the forex over there, which has hit the markets. Demand has been under pressure. So the margins too are expected to contract on a quarter-on-quarter basis because of these issues. We are awaiting more details from the management, so the commentary will be important as to whether the worst of exports is behind us. They did mention that July onwards exports will start to pick up, but that's something that the street will watch out for very closely. And on the domestic market as well, Bajaj Auto, of course, is getting set for a new launch. There's the Triumph Bajaj bike that will be coming out on the 27th of June. So the domestic market is looking pretty strong. But otherwise, it's a mixed set of numbers that we're expecting from Bajaj Auto.
Okay. No, got that. Just a few more names in the broader market. By the way, the market with 20 points of gains, I think, is at almost the high point of the day. There's a recovery which is setting foot. The low was 17,716, and from there we're up 40 points or so on the index. So this is good going. The rail stocks are once again jumping like yesterday. RVNL is now up 9%, and RITES is up 6%, 6.5%. So there are these two names which are looking good. Adani Power and Adani Green have come back into and Adani Enterprises. So that's a group which is doing well in the range of 4 to 5% on all three names right now. Adani Total Gas is up 5%. So, I can spot 4 Adani Group names there. Bombay Dyeing is another one which is up 7.25% at about 88 with large volumes right now. And then there is Indocount Textile Company, which is up about 10%. 143 on Indocount is what you have right now. So that's, the listed gainers with volumes at this point. Market breadth is about clean 2:1, almost 2:1 in favor of advances. Well, it's a wrap on this edition of Bazaar. From all of us here, thank you very much for staying with us. Thanks for watching. Chartbusters comes up next.